The following is a presentation of TFNN. It is now time for the Diagnostic Trading Hour with your host, Darrell Martin. Now, Darrell Martin.
All right, folks, welcome on back here to the Diagnostic Trading Hour right here on TFNN. I'm your host, Darrell Martin. Don't forget you can listen to us anywhere on your mobile phone at TFNN.mobi with 9 hours of live trader commentary a day. And let's check out what we got going on. We got the S&P after making a run back up, went on down. Now it's down about 9.5 points with the Nasdaq down 10.5, the Russell down 7.9, and the Dow started to do a run back up to settlement and turned around and is now down 118 points. We got gold right now is up 30 cents, just a mere 30 cents on the day. We got silver is down about 1% on the day, and copper's down about 0.5%. Oil's up $2. So massive move on oil, up over 2% on the day right now. We got natural gas is currently down about 1%. We got corn up $4 on the day. Soybeans is basically flat on the day at the moment. We got euro dollar up 64 pips, pound dollar at 55, Aussie dollar at 14, euro yen is down 19 pips, dollar yen is down 64. So a lot of strength in the yen there, weakness in the dollar, bringing that one on down. We got the pound yen down 42 pips, and I got the dollar CAD currently up 23 with the dollar franc down 58 pips on the day. So that gets you your current market wrap, and one of the things I talked about yesterday in quite a bit of detail, I went through all of the news reports for the week for you, so make sure you go back and check out the archive of that over on the Target TV archive channel there. And if you don't have a Nadex account, because this is how I trade the news, I trade it using Nadex. Hop on over to the homepage of TFNN, click on the Nadex banner. As soon as you do that, just click on Trading, right? So what you want to do, you want to trade, and then go to Demo Trading Account. Once you click on Demo Trading Account, fill in your username, first name, last number, phone number, and email address, and it takes about 10 seconds. They're going to email you a password, and then you'll be able to log in right away. Okay? Now to get your live account, it's only a $100 funding requirement. There's no day trading margin, $25,000 thing like stocks. You don't have to worry about things being assigned to you or called away from you, like puts and calls. You don't have to worry about last trade date, settlement date, delivery date. You don't have to worry about making or taking delivery of commodities, all that stuff, like futures. There's no margin calls ever because the amount you put up is your max risk. But the leverage can be extremely high in one direction, but it doesn't cut against you unlimited in both directions, because a lot of times when you hear about leverage, you think leverage can cut both ways. Well, that's not exactly how it works on Nadex, because the risk is capped. Okay, so you can go and you can trade things like gold, oil, silver, copper. You can trade euro dollar, pound dollar, Aussie yen, pound yen, euro yen, dollar franc, dollar CAD. So there's a lot of different FX pairs you can trade. You can trade the DAX, you can trade the FTSE, you can trade the Nikkei, you can go and you can trade the S&P, you can trade the small caps, the Dow, Nasdaq, all those. So you can go through and trade just a large variety of markets, but with completely defined risk, and you can even do smaller position sizes. So if you want to go and you want to trade half of a small cap 2000, how are you going to do? How are you going to trade half of the Russell? Okay, besides going in and putting up a large amount of money with IWM, ETFs. How are you really going to take advantage of that and do that with a very small amount of capital? Well, you can go and you can trade the Russell using spreads over on Nadex. And to give you an example, and let me show you this. This is actually inside the spread scanner. We have a link over there on the TFNN homepage. You can get access to it. But let me pull this up and just sort of show you right here how this works. Okay? So we go and let's say we choose, the small cap. And on the small cap 2000, that's the ICE E-mini Russell 2000 contract. It's currently following the December futures. So you'll notice that's in the name of the contract right here. See December right there. I also put it right here on the scanner for you. In addition to that, I give you let's say the Thinkorswim symbol would be /TFZ3 or just /TF, it'll roll. And then like a Ninja TF1213. So I'll give you the Ninja symbol, Thinkorswim and other platforms use, or some platforms will use the letter instead of the month. And Then right here, I give you the tick sizes and the tick values. Well, on Nadex, on every single market, when you're trading a spread, on every single one, the tick value is always $1. So you don't have to deal with, like, this tick's worth $12.50 and this tick's worth $25 and this tick's worth, one. You don't have to deal with all that. Every tick is always worth $1. So if you want a tick to be worth $10 to you, and every tick's worth $1, how many contracts do you need to make it worth $10? 10. Pretty simple, right? If every tick's worth $1, and if you want a one tick move to be a $10 move, where you need 10 contracts. So look right here. We say one Russell, one TF contract equals 10 Nadex contracts, because a tick on Nadex is $1. A tick on the Russell 2000 E-minis is $10. Now, one of the reasons this is so cool is because, like I said, how do you split, the E-mini Russell? You don't. You're already at the mini, okay? How do you split an E-mini S&P? You don't. Well, here on Nadex, you could do 1/10. You could do 5/10. You could do 3/10. So whatever your risk is, you could actually adjust your risk proportionally versus always having to risk $10 a tick. You could risk $7 a tick or $3 a tick or whatever, just how many contracts you want to do, and it helps you control your risk management a lot better. Okay? Now, also notice how they tick the same way. All Nadex products tick in a increment of 1. Now, whether it be a 1 like the Dow moves in 1, 2, 3, 4, or maybe like the Russell moves in 0.1, so 0.1, 0.2, 0.3, or maybe it's something like oil that moves in 0.01, 0.02, 0.03, or natural gas has 0.001, 0.002, 0.003, and then you go to, like, say your dollar, 0.001, 0.002, 0.003. Notice they're always going to move in an increment of 1. So you don't have like quarter ticks and eighths of cents and all this other stuff you got to deal with. It's always going to be an increment of 1. And that 1 is always going to be the last digit of the quote. And you could literally just drop the decimals to make it easy if you wanted to, and just look at it and go, okay, it's going to be 5, 6, 7, 8. Whatever the quote is, that's the tick. And that tick is always worth $1. So it makes it really easy to calculate everything. And you can go in here and, you can check out with the scanner. You can go, what do I want to do, on the small caps? And so you're trying to, make a decision on what to do. The market's been, heading down after a rally up, and you want to decide your next move. Well, the good and the bad about Nadex, okay? The bad part is you have a lot of choices. It's options, right? So options give you options. And the thing is, whenever you're watching charts and you're trading, you don't want to spend a lot of time analyzing options. But you do want to make sure you have the right choice. You don't just want to go, well, I pretty much know that this is basically what I want, but not know that it is exactly what you should be choosing. Is it the best one? Because you go in and you just sort of randomly use a little quick method, and let's just say that cost you $5, but you do 10 contracts, it costs you $50. You do 20 trades in a month, you gave up $1,000, okay? Whether it be in lost profit or whether it be in additional losses, either way, you gave up $1,000 along the way. And so you want to make this, really simple. So if I'm looking over, say like at the Russell, and I see the market's, heading down this morning, and I'm like, okay, going into the afternoon, we're still, like we're punching down pretty good, and I want to make a trade, I'll hop on over here to the scanner. And on the scanner, I'll get rid of max risk. I don't really worry about that, okay? And I'll show you why here in a minute. Put 0 in there. There we go. And I'll put, maybe 0.5. And then if I want to mirror the market, I'll choose an at the market, okay? And because think about it, it is an option. So think of like calls and puts for day traders would be a way to, think about it. They actually use a Black-Scholes model just like calls and puts. And you can go in and instead of, having to pay for 5 days of time decay, you're only paying for hours or minutes or a day at most. And so your premium is much lower. Also, your implied volatility has much less impact the closer you get to expiration, the smaller your vega is. So vega becomes less of a factor. All right? Also, the closer you get to expiration, the higher your gamma is. So your delta approaches 1 very fast, if not immediately. So therefore, now you get that delta of 1. So now you're not worried about gamma and delta. And then, of course, your theta is much lower because you don't have to worry about time decay because you only have hours, So you really get to eliminate your concern with the Greeks, and you can just look at it in a very plain numerical fashion without having to go into a bunch of formulas and details. And so if you say, hey, I want to sell the small caps, they're moving down, you get to see what's available, see if you like it or not. Okay? So like here's the small caps right here. And I can look at a variety of contracts. I got ones that expire at 2, ones that expire at 3, ones that expire at 4/15. I can see what the max risk. Now this is if I wanted to hold the thing all the way till expiration. I don't have to do that, right? I can get in and I can get out of the contract anytime I want to, just like anything else that I trade. So again, get in, get out. So I can get in and 30 ticks lower, I could buy back and get out of the trade. And as I'm doing these trades, I can basically look at a lot of different ways to take advantage of them. But things you want to look at first, and this is what the scanner helps you with. So because if you're inside the Nadex platform over here, then you're going to go in and you're going to choose small caps, and then you're going to have to click here. And I'm on binaries. I mean to be on spreads. So you go bull spreads. Okay, now go here. And now I got, these I got to look at. I got these right here, and then I have to do all the math in my head, or I have to manually open the tickets. Then I have to assign a contract value to it to even see what the risk reward is, and then to do, other important factors. I mean, there's just a lot I have to do, and I got to click at least right here, at least 4 times to see every potential contract that's currently available. So sometimes more than that. Like if I go down to euro dollar, I mean it could literally be through the roof. So we'll go over here, and now I see these are all the contracts that meet my specifications, which are pretty simple. I just said at least a half, reward to risk ratio and a sell direction. So that just sort of narrows down the choices for me. It makes it really simple. It doesn't rule anything out. But the big thing was I said at the market. So 8 ticks, 10 ticks, 11 ticks, which isn't really bad. I mean, that's a point on the Russell. That's not a big move. Okay? Now, if I wanted to get rid of that parameter to see if anything else showed up, I could go in here and I could just say all. So what do I mean by this whole break-even distance thing? And, in this case, it doesn't really affect it. So what the break-even distance is what is the difference between where the spread is currently priced and where the underlying market is currently priced? Okay? So if I go in and it's sitting at, let's see, we got the Russell right here at about 1121. So if we go over here, 1120.2, well, that's 8 ticks. Okay, 1121 minus 1120.2 would be, 0.8 or 8 ticks. So it tells me immediately what that break-even distance is. Now, what does break-even distance mean? Does that mean how far a market has to move for me to be able to be profitable? No. Okay, that sort of catches people up. What it really means is as of expiration. So when this thing expires at 2 o'clock, how far would it have to move? So I'll go back over that concept for you to make sure you have it down 100% right after this break. Stay tuned.
Who says you can't take it with you? TFNN says you can. With your mobile device and TFNN's live radio streams, TFNN has put it all in the palm of your hands. No special apps to download. No subscription fees for live radio or Tiger TV streams. We say you can.
Now let's go over to the dollar, because the dollar is going to be the generator. It is the generator of basically higher dollar, lower market. And what the dollar has done, and this whole uptrend, folks, has just gone sideways. The way it works, folks, is this.
We say you can. The Tiger Financial News Network. Smart investors and professional traders know you can. TFNN.com. Educating investors. with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pezzamento, Andy Hecht, Victor Jones, or Darrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Patterns, profits, and peace of mind.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pezzamento's trading newsletter.
Patterns, profits, and peace of mind.
In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 full weeks. That's an $85 value. Yours free when you register right now.
Get Larry's Patterns, Profits, and Peace of Mind.
And get the edge you've been looking for.
Investors, Taz Market Research delivers to its subscribers expert commentary on the analysis of 15 different markets each day. Get this invaluable and timely information through the daily market research videos Taz Market Research produces each day before 9 a.m. The video analysis will include reports on currencies, interest rates, indices, metals, energies, grains, and more. You'll be able to gauge where high profitability setups are in each of the markets. Receive a free 2-week trial subscription to Taz Market Research videos on the front page of TFNN.com. Darrell takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
All right, folks, welcome on back here to the Diagnostic Trading Hour. Your host, Darrell Martin here, and we're talking about what does the break-even distance here mean on the scanner? What is the definition? How does that work? How does it help you in your trading? Okay, break-even distance is the difference between the underlying market and the spreads price. Okay, so that's a pretty simple concept to get there, okay? So, if you pull up a chart and you're looking at, how they're quoted, then basically your break-even distance is simply going to be the difference between the two. So if we go here, 11.20, 19.8, 11.19.5, it's just fluctuating around here. 3, 4, 5 ticks, break-even distance. So pretty small break-even distance right there. And what that's saying is, like if I sell right now for 1119.5, and the market's at 1119.9, okay, I sold 4 ticks lower than the market. All right, live, immediately. I'm in at 1119.5 on the spread. So there's basically 4 ticks of premium or time value in there. Okay? And to make back that time value, the contract would have to settle at the price I sold, okay, at the price I sold the spread at, or lower. So if I sold the spread at 1119.5, it would have to settle at 1119.5, then I would get back all of my risk capital. So if I put up $35 through the trade, they'd give me $35 back because it settled at the price I sold it at. And settled at, what does that mean? How does that work? We can go into the details, and I'll run through that like really quick, but then I'll go into the simple version. Settlement means as of expiration, as of 2 p.m. when this spread expires, they're going to take the last 25 trades, they're going to average the middle 15, okay? And that's going to be your settlement price on any time they do a future settlement. So when that settles, then if I sold, then settlement is considered, think of it like buying back. So if I sold at 1119.5 and I bought back at 1119.5, I lost nothing. I made nothing, but I lost nothing. You got fees, you could say, but just looking as far as just the market itself. So really no loss on that. Now if I go in and I sold 1119.5, but it settled at 1119.6, be like buying back at 1119.6, so sort of like it's closing out your trade, buying it back for you, then I'd lose $1. If it settled at 1119.4 and I sold 1119.5, I'd make $1. Okay? So pretty simple. Just think of settlement as like closing out the position. So if I sold, it's like buying back. If I bought and it settled, it's like selling back. Okay? So it's just getting out of the position at that current market price. That's break-even distance. Now, it's not like that premium just disappears immediately. So if I get in a trade and there's 6 ticks to break even, does that mean it has to move 6 ticks? Not necessarily, because, again, the premium doesn't just disappear because I got in. So it may not have to move that far at all for me to be at break-even. Okay? So, but the break-even distance deals with expiration. Okay? Now, one thing you do want to understand, one thing that is helpful is this is pretty much when your delta is going to hit, right out of 1, that break-even distance. So it's going to seem a little slower. Like sometimes I see people go in and they're like, oh, I like that one. It only has $5 risk, but it has like a 30-tick break-even. And they're like, man, Nadex moves so slow. Why am I not making anything? Okay? So when you do this, just go in and understand you want a small break-even distance because that's going to get you, instead of having to worry about gammas and deltas and all that stuff, the faster you move that distance, then it's trading on par, and so it's going to start moving at that 1-to-1 delta. And as you can already see, we were looking at, and we're already in profit on this trade. It's going down, and it's following the market using the spread. When we were looking at the trade, we had about a $30 risk on the trade, so which would have given us a 70-point wide spread, so about a $40 profit potential. Hey, if you can grab 4 points on a Russell contract in and out, that's not bad at all. And a 3-point risk with no stop loss. So anyways, but check that out. That's break-even distance. It simply means how far does it have to move at expiration for you to be break-even or profitable. And another funny little thing, people sometimes think about, like, it has to expire inside the spread box. It doesn't have to expire inside the spread box. Okay, if I sell and it expires 20 points below it, it doesn't matter. I make max profit. Okay? So it doesn't have to stay. It's not like a range-bound trade. Okay? And when I say spread box, what do I mean? Well, if we see, like right here, it says 1116 to 1123, then that's basically what I call a box. I call them box spreads a lot of times. So if we go over here, I'll show you what that means. Like, what is this floor and ceiling? And then how can you start using some of these pieces to your advantage as a trader? Maybe even you're a futures trader. And this is really cool if you learn how to use this correctly in combination with your futures or forex trading. Stay there. We'll be back after this break.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's Nadex.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
With over 3 decades of trading experience, Andy Hecht brings a tremendous amount of knowledge and expertise to each weekly issue of his newsletter, the Technomental Commodity Report. The Technomental Commodity Report gives you Andy's unique technomental analysis of the commodities market, a combination of technicals and fundamental analysis which he has developed and perfected over his many years of trading. The Technomental Commodity Report is only $49 a month, and right now you can get a full month-long trial subscription while paying absolutely nothing. See for yourself the kind of weekly report Andy delivers to his subscribers every Thursday morning. You'll receive specific stock, ETF, and option trades based on Andy's analysis, so no futures account is required. For all the details and to start your month-long free trial to the Technomental Commodity Report, visit TFNN.com today.
Darrell Martin coined the phrase diagnostic trading, and we're happy to announce that his Diagnostic Box Spread Analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Darrell Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
All right, folks, we're going back here to the Diagnostic Trading Hour. And let's see where things are at. So we're going through a couple different markets, checking things out, but I wanted to hop back over and stay on track on this same contract we've been discussing for the show here over on the Russell. So let me pull that back up. We'll look at it in detail here. And so the contract we've been looking at, just for example purposes here, is 11.16 to 11.23. And what I'll do sometimes is I'll go in and I'll actually draw a box on the chart. So right down here, 11.16 to 11.23. So right there. So we looked at getting in right about here. And so nice profit. Now a lot of people go, well, I don't like that there's a limit on the box, and they're trying to understand the box and get how it works. So let's go through a few things on that. One, where you get in, that's the left side of the box. All right? Where you get out, or the expiration, that's the right side of the box. The ceiling, if you're selling, okay, the ceiling, you can't lose any additional money above that line. So if you had a $30 risk when you got in, you would not be able to lose more than $30 on the trade. No matter how high it went, you'd still be in the trade if you wanted to be. But, I mean, there's no reason to get out if you're at max loss. But it could come back down. Just like people go, well, how's that possible? Well, think about a call on any stock in, one of 3,000 optionable stocks. It works the exact same way. Okay, you buy a call option, somebody sells it, whatever. you have limited risk, you have, upside, they have uncapped risk, etc. Okay? So it's not abnormal, it's not weird, it's not too good to be true. It's how options work. All right. So there is a cap on the ceiling, okay? And then right here there is a cap on the profit potential. Now, this can be, you can roll over to a new spread, you can choose a wider spread, you can uncap it by doing what's called hedging. So we may talk about that for a few minutes today as well. But you can go in here, and so the ceiling being 1123, the floor being 1116, you're trying to decide, is this a good choice when you're getting in up here? Well, let's look at this. The one deviation level is at 1115.4. The floor of the thing's at 1116. We're only talking a few ticks off of just a one deviation move, which is really about all we expect 70% of the time is a one deviation move. So, meaning majority of the time, that's more than enough distance. So I don't need to worry about my profit being capped, because I know we all want to ride everything for 500 points and all that stuff, but in reality, how many points are you really taking on a consistent basis on your trades? So that's one thing to consider. Now, also, I could get a wider box. I mean, you can go down here, and there's other boxes. I mean, this one goes down to 1100. Okay? So, there's one that goes down to 1105. So if I really think that I'm going to be able to go in and catch this thing for just a massive move, I can add those on. But one of my favorite ways, okay, to do these types of trades, probably my favorite strategy on Nadex, is I'll go in and I'll flip it around, okay? So we'll go in and we'll click buy. And then what I'm going to do on these buys, there's a whole bunch of them showing up, as you can see. I'm going to find one with ideally as low risk as possible and the smallest, basically just the smallest risk possible. But at the same time, I want also a low break-even distance. So I can go up here and go, okay, well, that's actually not too bad. That's a $19, 16 ticks. So let's see here what else we got. And I can look through all these. But if I choose that right there, that basically means I have to make about 16 ticks to be break even on the trade, but I'm going to do something that's totally opposite. So if this is like an 1119 to 1126, what I'll do is I'll go over here, and let's say you wanted to short right now. Okay? Take this and I bring it on up here to about 1119 to 1126. And let's say I was going to add on at this point. Now we were talking about going short. We already went short up here. But let's say we're going to go short now. I could actually buy this spread. Okay? And I could sell the future. Now remember, you got to have that ratio. Remember, you want everything to be tick for tick, right? So if $10 per tick on Russell, then I'm going to want 10 Nadex spreads. But I could go in here on this trade, and let's see, let's put this on top. There we go. And if I'm looking at this one, I wouldn't get in quite yet. I'd wait till it breaks down and starts moving back in my direction. But at the moment, anyways, let's just say we did hop in here, okay? Then I would have a hedge all the way up to 1126, because that's the ceiling. Remember, that's the maximum profit that I can make there, 1126.5. So I'd have a hedge up to 1126.5. Okay? And how much would I really be risking? Well, let's come back to that break-even distance concept. Break-even distance is the difference between where the spread is priced and the underlying market is priced, right? So break-even distance is the difference between where the two are priced. Then I can go over here and go, okay, well, 1121.5, buy, sell at 1120, 15 ticks. What is my risk? My risk is actually the difference between the two. So if I'm selling at 1120 on the Russell future TF contract, okay, TF 1213, TFZ3, and I buy the spread at 1121.5, that's in essence like buying and selling at the same time with 15 ticks difference. So my risk being on 10 spreads, one future, short 10 spreads, long one future, is 15 ticks. That's $150. That's a 1.5 stop loss on the Russell. That's nothing. Okay? So that is my max risk on this trade. Up to 1126.5, I won't lose. As of expiration, I won't lose more than a 1.5. But I have basically a 6-point stop loss from where I'm at right now, 6.5-point stop loss. So I have a huge stop loss, but I'm only risking 1.5. This thing would have to go all the way back up here, and then I'd have to bail on the spread and close out my future, and I'd lose $150. But the cool thing, this is why this is probably my favorite strategy, being just I love trading futures. You go in, and as it ticks higher and higher and higher, let's say you actually set a stop loss 1.5 points up, and I usually set mine higher if I'm just doing outright trading. So if I set think about it, what happens as it ticks higher towards that? You went short the Russell. You got a stop loss, 1.5 points away, and every time it ticks up, your heartbeat goes up a little bit, right? Ticks up a little bit more. I mean, it's and you're trying to deal with this. And now all of a sudden, this is where the trading psychology starts coming into play. Okay, should I move my stop? No, but the last time I did it worked really well. And based on what I see, I think that if I moved it up just 5 more ticks, I'd be okay and I won't get stopped out. Or do I honor my stop? Okay, well, I hope I don't get hit, right? And then if it does hit my stop, then what am I going to do? Am I going to go short again on the next potential entry? Am I going to go long? Am I going to just sit out and then watch it drop 10 points? That's one of the most painful things that can happen. Well, with this, I'm only risking 1.5, so I have great risk management, but it could go 7 points against me. My heart's not beating. Okay, if the thing goes 7 points against me, I need to be out. All right, I'm okay with taking a 15-tick stop on a 5-6 point move against me. So if that's what I need to do, that's perfectly fine. But you're talking 50, 60 ticks against you. You only had to lose 15 of those. So I go in, I hop in, I decide to do this trade, and so I would literally go short the future. I'd buy 10 of these spreads, and now we understand the concept of our risk is simply the difference, the break-even distance, the difference between where we sold the future and bought the spread. And we're protected up to the ceiling, if we're going short the future, up to the ceiling of the spread. So you'd have a stop loss up there on your future contract, and a take profit up there on your spread contract. And then, now if we bought, it'd be the reverse. So if we decided the market was going to go the opposite direction, and we grabbed, say, this spread right here, then we bought, then we'd be protected down to the floor of the spread. And this basically helps you eliminate stop losses. You don't have to worry about every little tick, and hoping it ticks against you. And it also is the way to get actually this lowest amount of risk possible. It's honestly often less risk than doing just a spread with the tighter break-even distance. Now, a couple variables to think about on this strategy, but you can do this on euro-dollar. Euro-dollar, a mini lot equals 1 spread, so it's really simple. But you can go in here, you go short, you do this trade, and then as it starts moving down, you got to do one thing. You got to recover the cost of the spread. Okay? So what I have to understand is that, that break-even distance sort of works in both ways. I'm going to have to make that money back that the spread's losing. So if I went short the future like we were talking about originally, and I bought the spreads to hedge, then, if I ended up putting, say, $20 risk, which is 20 ticks, then I basically need to make 2 points below the spread. So I've lowered my risk, but it has to move, basically that same break-even distance for me to make that money back below the spread. I got to make that spread money back with the future contract. That's pretty simple to do, considering the fact that when we were starting on the trade, we were actually inside the spread. So if I had $20 risk, that just means I needed the future to move down 20 ticks. Okay? Which, if we were 10 ticks inside the spread, I would need to move 10 ticks outside the spread. But the bottom line, the simplest thing to conceive of here, is whatever the risk is on the spread, I need the future to make that much, and that's my profit. Okay? So as soon as the future makes whatever my max risk is on the spread, then everything's profit from there. But I have until expiration of this spread to be profitable, and I can even roll it over. I can add a new one on. I can do a lot of different things, but that's the most important concept is you get more time to be right, and you lower your risk. You just add a little bit of break-even distance movement requirement, but you lower your risk, you give yourself more time. And that literally is my favorite strategy. I'll even go in sometimes and I'll scalp. Some of you guys out there are scalp traders. Some of you girls like to scalp. You go in, you pull off a couple points, thing pops back up, you short again, a couple more points. You literally just keep doing this over and over, and especially you get like in a flat oscillation zone area, maybe like at a 1 deviation level or whatever. And you can literally just scalp, but you got a hedge on the entire time. So you're going for like, a point, maybe 5 ticks, and you literally just repeat. Every time it oscillates, you just hop back in and hop back in. But if it blows against you, you don't have to worry about having like a 5-point loss, 25 tick loss on that could be 50 tick loss on the Russell, when you're only going for like 5 ticks at a time. So it's a very cool way to be a scalper if you like to scalp. You don't really scalp with the spreads, because just the bid-ask spread and all that stuff, but you can use them to scalp the futures and hedge your scalps. And after you've made the risk of your spread, okay, then at that point, you're pretty much in the money, and you just enjoy the oscillation. So on a flat day, this is a cool strategy to go in and just start doing scalps near deviation levels. So that's something else you can do. As the market's moving down, but you think, hey, you know what, we're at this 0.7, this thing may reverse. Maybe you got into a trade earlier, okay? So let's say you got into a trade like way up here. You just called it. Market's moving down. You notice it hits this 0.7, and it's really oscillating around. It's sort of freaking you out. You're like, well, I think we may get down to 1. I don't want to take it off yet. I don't want to get stopped out. I don't want to give up a whole bunch of profit. You could actually just add on. So let's say you went short up here earlier in the day on this contract, and went down. You see it, hesitating. It may or may not hit that 1 deviation level. Now you could add on a spread. Yeah, you're going to give up, say, 5, 10 ticks, 15 ticks of your profit, but you can eliminate that stop loss, let it move around a little bit. Maybe it'll zigzag a little bit on you, and then come on back down. So you could have done that at every deviation level. It could have came on down when it hit the 0.5. You could have said, okay, time to put on a hedge. You give up a few ticks, this thing moves up, but it moves up like 4 points, right? So it moves up, several points against you, but you're only, down 15 ticks of your profit, okay? So you're still profitable, but you didn't have to add on another position. You didn't have to get out and get back in and take on a full risk again. You just added on the spread to trail your stops. Goes down to the 0.7, you can do the exact same thing. Comes down to the 1, you could do the same thing. So you're giving up a little bit of that profit along the way, but you're lowering your management of the position. You're not having to worry about oscillations kicking you out of the trade too soon. You're in place if there is a big move for it to go in your direction. And if it does, move up against you, you captured that profit in the spread, so on the money you gave back up in the future. Now, maybe you don't have a big enough account to trade futures. Maybe you don't want to do futures. Then what can you do? Okay, well, what you can do is simply trade like the master spreads, or you could trade just the middle spread as your synthetic underlying. So you want to find one that's really close to break even with, honestly, it's probably as much time as possible. So you're more like, 415. So you're more mirroring the underlying. So you go over here, and this is where I would pull up both. Okay. And I'd go, okay, well, let's see. What do we got here? I want to really close. Let's see. There's 415. So one of these two, I'd probably want to choose this one. Unless you have a money limitation issue, you could choose this one right here, like $55 versus $101. Now, again, max risk does not mean your risk, okay? It means the worst case risk. If you don't hedge it, if you don't close it, that's your risk. So let's just say we choose this one right here, and then we go up here, and we're going to use that as our small cap short. And then I go up here, and then I can hedge it off, okay, with another one. And we'll talk a little bit more about how to choose what spread to hedge with when we get back after this break. Stay right there.
You take a hands-on approach to managing your investments. And whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today. Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Have you subscribed to the Gold Report yet? On Wednesday, August 14th and Thursday, August 15th, Tom O'Brien advised his Gold Report subscribers to close out 6 of their 9 open positions, all winning trades ranging from a 10.69% profit to an incredible 48% profit in just one equity. Tom O'Brien brings an incredible wealth of knowledge and experience to the gold market and the equities within the industry. That's almost 12 years since this powerful newsletter first began. And right now, you can get a 30-day free trial to the Gold Report by visiting TFNN.com. Make sure you're a subscriber as this volatile gold market makes its way back into positive territory after declining all the way from $1,900 to under $1,200 an ounce in only 2 years. Get your 30-day free trial today by visiting TFNN.com.
Join David White as he keeps you up to date on the latest tech stocks while he uses his Power Law Vector Indicator to identify the best trades. The Power Trading Hour, next on TFNN.
All right, folks, welcome on back here to the Diagnostic Trading Hour. And just in case you want to make sure you grab the news archive from yesterday, I wanted to show you where I went through and talked about the news from last week. Going over to TFNN and click on Tiger TV, then click on Channel 7 right here for Diagnostic Trading Hour. When that comes up, click on the YouTube link right here, and what that will do is it will load all the archives for the Diagnostic Trading Hour for you. And if you check out December 2nd, I walked through the news step by step before you get a request for that. I just want to make sure that you knew where to grab that information so you'd be ready for the week. All right, so what we're talking about right now on here is how to find the best spread, okay, for, hedging. So let's say if we were going to go in and we were going to short this 1105 to 1125 spread over here, we wanted to hedge, then, you could choose the 415. That is an option, of course. But if you do that, you're going to be paying usually more for premium and you really shouldn't need it. If you're doing a day trade and you're not right within like an hour or so, moving in your direction, it's probably not your trade, okay? So what you do is you go in here and, I usually find, a shorter term one, obviously not 4 minutes, right? Like, that's not going to do you any good. But I'll go in here and maybe find this one, 64, minutes on here. And that could be a trade, potentially worth doing on it. So let's, 64 minutes, so we don't want these. We'll go, okay, I want at least an hour. So if I know I want at least an hour, I can actually just put 60 right here in the minutes. And that'll shrink it down. And now I get rid of those 4-minute contracts. Once it updates, there it goes. And then I can look at, what are the potentials. Now, I may or may not want to use these. I just got to look down and see which ones I like. What the, is the risk acceptable to me? That has a $45 risk on it. Not really going to be my trade. This one has a $7 risk, but it basically is a 3-point stop loss. Remember, break-even distance is my risk on the trade if I sold versus where I bought. So I may choose to take on a little more dollar risk on the spread because that'll actually give me less risk. So risk on a hedge, don't look at max risk here. It sounds sort of weird, I know. But risk when you're hedging, when I'm selling one and buying the other, is going to be my break-even distance. So I'm probably going to be more focused on that one. Now, you may be tempted to go and look at it. Wow, this one's only 4. Why don't I do that one? Well, because now we got to look at max risk. Now, this isn't risk as in dollars at risk, because remember, I'm selling one, I'm buying the other. But what it is doing is I'm putting up, basically I have to make back that spread money, okay? So I'm not really going to make on anything until this thing gets below the floor, and it has to move quite far. And check this out. This thing's at 11.15. Well, the market right now is at 11.20. So that means the market has to move 5 points down plus another point to make 60 ticks, okay, for me to be break even. So it's almost like it's basically inverted if you're looking at a hedge. The max risk becomes your break-even distance on a hedge, okay? And the break-even distance becomes your risk on a hedge. So if you're hedging, if you're selling the future, or you're selling like a master spread, middle spread there, and you're buying a spread, break-even distance becomes your risk, and max risk becomes your break-even distance. Again, this is just on a hedge, and this is a little more advanced concept. But if you will pick up what I'm putting down here, if you'll put this together, it is one of the most amazing strategies. And so I drop this one off. I drop this one off. I don't like those. If I'm okay with a 3-point stop loss, great. I mean, it's a very close. I can 10 ticks. I'm break even, but I'm willing to risk 3 points to do that. So I may not be comfortable with that. This one right here, it has to move 2 points for me to be break even instead of just 1. But I'm only risking like $110 on 10 contracts. And I can do them together in the same account, so that way I don't have profits and losses in different accounts. If I do both of them by doing a spread and a opposite spread, not a straddle, but one where I'm hedging, then I'm able to really lower my risk overall. I'll go over this even more detail tomorrow with you to help you get it down. Y'all stay tuned. We have another great show coming up for you right after this.
What's the one thing that pulls people back from the breakthrough that they're moving towards? What's the only thing that really stops people from taking action? You and I both know the answer, and sure, we can come up with the reasons why we're not where we want to be, but the only reason that we don't do more with our life is fear. Or if you're an overachiever, call it stress. Simply put, there's something that happened to us in our past that's holding us back from the life we deserve. Yet, you and I are okay, we're here. So why should we let our past control our future? Exactly. We shouldn't. Hi, I'm Steve Rhodes with TFNN.com, and when it comes to your trading and investing, I can help you overcome your fear of loss. Together, we'll turn weakness into strength with a system I've developed called Mastering Probability. I'll teach you how to make your money work harder for you than you do for it. I'll teach you the tools that provide financial freedom. Go to the homepage of TFNN.com, click on my name, Steve Rhodes, and begin your journey of mastering probability risk-free. It's time to become a pioneer of your future versus a prisoner of your past.